But of course the construction activity has hit a low point, and that won't be complicating the recovery for retail. You can see 2010, it's not really until 2011 that we start to get some new stock coming into the market in Melbourne, mostly in the form of bulky goods. But there are some very strong long-term drivers in Victoria which are scheduled to sort of underpin the retail market. One is population. This is just an example that, in the next 10 years there's meant to be 786,000 new people coming to coming to just to Melbourne. Floor space per person at the moment is about 1.4 square metres per person. So what this means is that technically we need another 1.1 million square metres of retail floor space just in the next 10 years. This would equate to 9 super regional centres, or about 6 new Chadstones in 10 years, or 110 neighbourhood centres. Now, of course, it's just not going to happen. So the market's just getting tighter and tighter. So the competition for existing owners, those who hold centres, is just not going to be there, and the growth in retail turnover is just going to continue to go through existing centres rather than be dispersed into new centres. So it's a pretty strong environment in which to be getting into. It's no wonder that the retail sector is so tightly held. So turning to pricing as a way of summary, you can see that these are the changes in yield over the last few years, the big blowout in 2008, and now we think there'll also be some yield compression in 2010 in the retail sector, but quite different. The rule of thumb is that really the bigger the centre, the less of a compression, because in the first place there was less of a blowout in the bigger centres. They performed the strongest. You can't have it both ways. So bulky goods, the neighbourhood centres, and perhaps the sub-regionals will experience, we think, some sort of yield compression around 20, perhaps up to 40 basis points in the next 12 months. So that's some of your recovery in those smaller sectors, but the bigger centres will probably, we think, have a more stable yield outlook. So let me summarise the retail market. Turnover will grow modestly in 2010, surprisingly, perhaps the only sector that's acting counter-cyclically for the year ahead. Some of the Victorian demand drivers are set to grow well above national averages, especially the population. Development opportunities are re-emerging, although it's going to be very difficult to implement those. Most value we think in the year ahead will be added through yield compression rather than stronger income growth as retail spending coming off a little. And don't forget too, there's really quite a wide gap between prime and secondary assets. We think some of the opportunities for the year ahead will actually be more in the secondary markets, and perhaps potentially moving those up into the prime to capture some of the growth in the medium to long term. So that gives you a bit of an update on the retail market. So now to hear the word from the street, I'd like to invite up to the stage Mark Weisel. So please join me in welcoming Mark Weisel. Okay, the good thing about retail, Mark, is that there's always something changing. There's always something happening in the background with retail. We've seen a bit of action recently on the tenancy and the retailer side. Tell us a bit more about what you're seeing out there on the street. Yeah,
well, good morning, everybody. You're definitely correct in saying things are always evolving, things are always changing in the retail space. We're effectively seeing two different trends emerge, and our research and on the street deals sort of indicate the trends can be categorised as a trend in the Melbourne CBD and in the strips, where a number of international retailers are looking to take space within our CBD and also within our strips. I think there's a slide that will come up on the monitors out there which shows some of the brands such as Abercrombie & Fitch, Zara, which is one of the largest retailers in the world, and Gap, all who have requirements to take space in the Melbourne CBD at the moment. On the other side, in terms of the existing shopping centres and also in the greenfield sites, we're seeing the re-emergence of some of our more steady household names, and this is being driven by the strength of Woolworths and obviously Wesfarmers and the different brands that they carry with them. They're obviously quite aggressive at the moment to drive more stores and whatnot, so that's a big benefit for centres. And we'd also like to highlight the re-emergence and the re-strengthening of some of the second-tier retail tenants, such as JB Hi-Fi, Aldi, and obviously the Metcash IGA groups are all in the market looking for space.
So you're finding the phones are ringing for these guys at the moment. They need more space.
Yeah, absolutely. I mean, in terms of the international retailers, they've obviously got very specific requirements. So quite often they won't, even if it's a reasonable deal, but in the wrong location, they won't compromise their brand by taking that space. So really it's a bit of a wait and see game, a bit of patience, but we think for any owners of properties, especially within the CBD, to land a big requirement with an international covenant like that, we really think it puts them on the map.
Do these sort of international retailers, do they look at the rentals so critically? I mean, when they're working at a global level, so do they see Melbourne as an affordable option, or do they still try and drive the rents down?
Yeah, I think they definitely see it as an affordable option. One thing that we're definitely noticing in terms of how they assess a deal and how they approach it might not be traditionally based on rate per square metre or percentage of occupancy cost. And we think this has got a lot to do with, especially international retailers, wanting a presence within a particular market in order to cater for customers that they may have worldwide. And Melbourne's a great example of that. The high influence of Asian population, both for usual residents and visitors into the CBD, has been a big driver for some of these international brands to gain a presence in the CBD, just so when these customers are walking around, they do have a presence in the major capital cities.
Yeah. So let's turn now to the investment market. I mean, retail is renowned as being one of the most tightly held asset classes. Yeah, we know that the demand for retail assets came back before office and industrial in this recovery and really returned in the second half of last year. How do you see the year ahead, and how will buyers crack into this tightly held market?
Well, I mean, Victoria is a bit of an anomaly in many instances, and I think you can sort of analyse the rest of Australia and then particularly Victoria on its own. Traditionally, even through a number of different cycles, Victorian retail just hasn't been actively sort of turned over. So I think the demand has definitely sort of remained the same. There was definitely buyers out there last year who were sort of more blood on the street type mentality, and I think they were probably really bitterly disappointed that that sort of asset didn't actually hit the market. And now I think what's going to occur is they'll realise that we're probably a little bit better off buying sort of in the current market as opposed to what we were at the height of the market, and they might be prepared to cop sort of more tighter yield. So I think that's going to be the real trend this year. Any
particular price points you think will be more active than others?
Well, we'd obviously like to think there might be some activity in the upper end, but again, just the nature of how tightly the Victorian market's held, it is difficult to predict. We think there might be a little bit of turnover for some of the bigger stock, and some of the stock where potentially vendors may not have allocated the required capital to spend on the upkeep of the centre. Obviously, retail is quite capital intensive compared to the other asset classes, and that's both from a maintenance point of view, but also in terms of renewals and tenant retentions, and most importantly in improving the centre, giving the right incentives for the good retailers to come on board. So potentially vendors that haven't allowed for that may be caught out, and buyers may see that as a bit of an opportunity to come into the market.
Okay, any other sort of concluding ideas and opportunities for the year ahead?
I mean, nothing's really changed to any large extent. We still feel that the demand for the sub 35 million plus 15 million type bracket, call it a neighbourhood, is really strong. And we think that sometimes potential vendors may not realise how strong that end of the market is and how much depth to that market there is. One thing that we definitely alert vendors to is buyers at that smaller end are definitely becoming more discerning. So the actual fundamentals of the property, be it good car parking and just other great retail fundamentals, are really important in order to achieve really strong yield. But the buyers are definitely there.
Okay. Right, that's great, Mark. Some terrific ideas there. So good luck for the year ahead.
Thanks, Kevin.
Thanks for your ideas this morning.
No worries. Have a good morning.
We're going to move now to the final part of the presentation, covering the hotel sector, and of course that means in this context both pubs and accommodation. Pubs have been through an absolute roller coaster ride over the last 3 or 4 years, trying to get its mind around changes in the smoking legislation and a change in the ownership structures and institutions coming into the sector. The accommodation sector too has also been knocked around a little by decline in corporate travel, but again Melbourne has got off pretty lightly. But look, don't just take my word for it. Why don't we invite Scott Kello up to tell us what he's finding in the market at the moment. Please join me in welcoming Scott Kello.